This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Investment Perspectives. Well, it's difficult to find an asset class that hasn't rallied so far this financial year. US and Australian equities hit new highs. Bond yields are falling, which means capital values are up. Small caps have performed well. Gold is off the chart. And credit and property have also performed well. Momentum is, without doubt, strong, particularly in AI. But is this cause for concern? So to answer that question and provide further insights is our Chief Investment Officer, Tracey McNaughton. Welcome, Tracey.
Hi, Ed. Good to be here.
Tracey, we've got three big themes to unpack today, and they all tie together more than they might appear at first glance. Firstly, AI interconnectedness, the web of financial and operational relationships that's forming across the tech world, and what that means for systemic risk. Second, geopolitics and gold, why the metal's at record highs and what that says about trust. And third, risk management. How do you think about protection in an environment that feels increasingly stretched? So let's dive in. Tracey, let's start with AI. And OpenAI has been in the headlines almost weekly. There's new partnerships, huge infrastructure deals, and some very big numbers attached. But behind all that excitement, there's a growing conversation about vendor financing and related party transactions, or essentially suppliers funding their own customers. Now, you've been following this closely, Tracey. What's your take on it?
Well, I think there's a couple of things to say about this. The first thing is, Ed, that this growing interconnectedness reflects just how revolutionary AI is in scale, in reach, and just, in the sheer amount of capital that it requires. What we're seeing is a web of companies, the cloud providers, the chip makers, AI platforms. They all depend on each other. The second thing, though, to say is that this is really capital intensive. And so it's not that surprising that we're starting to hear about vendor financing. It's a common practice in capital intensive industries. It has happened in property, it's happened in autos, and it also happens in other forms of infrastructure such as renewables. In many ways, they are financing their own ecosystem. So the cloud providers are backing the AI firms that then become their biggest customers. But, it is complicated. We have the chip designers, NVIDIA, AMD. We have the chip makers, TSMC. We have the chip making machine makers, ASML. We've got the data center developers and managers, OpenAI. And then we've got the data center builders, Microsoft, Amazon, Google. And then there are the suppliers of heat management systems to those data centers, the distributors of energy to those data centers, and the makers of the energy that is distributed to those data centers. So the supply chain is long and complicated. Making it more complicated is the deals being done between each of the players in this supply chain, and specifically how those deals are being financed. So some of the deals are being financed with cash, others with credit, and others with equity. So there are risks. And because there are multiple suppliers to multiple customers, we need to think of this more as we've been saying, as a supply web than a supply chain. So, for example, if a chip maker extends credit to an AI firm that later struggles to raise cash, the chip maker's receivables get hit, but so does the demand, the future demand for its chips. But the impact doesn't stop there. The cloud provider supplying to that same AI firm sees that it's struggling to raise cash because of lower compute usage, for example. The cloud operator will then face slower demand for data centers. Capacity there begins to ease. Demand for energy therefore declines. And so suddenly what began as a financing issue with one company can quickly become an industry-wide slowdown.
So in effect, the same interconnectedness that amplifies growth on the way up amplifies fragility on the way down.
Yeah, I think that is exactly the way to think about it. When suppliers and customers are tied together financially, distress in one can cascade through the rest. We did see a version of this back in the early 2000s, late 1990s, with telecom equipment makers financing carriers. When the carriers defaulted, the vendors were left with the debt and less demand for their product. The problem we have here is that some of the companies doing the lending and borrowing are private. And we've spoken about this, and it's what separates this tech boom from the dot-com boom in the late 1990s. A lot of the ideas and build out is taking place behind the curtain, so to speak. That is, in private. I recall at some stage in my past, Ed, hearing the phrase, "When the curtain flutters, markets stutter." And it was in reference to confidence in the market. When the curtain of confidence wobbles, it can cause the market to hesitate or pull back, to stutter. I think that could aptly be applied here. I think we can't completely see what is happening behind the private market's curtain. But if we see it flutter, we know that the market will stutter. Now, equity investors understand that and are compensated with potentially massive gains that offset the risk of the private equity going to zero. But debt investors, though, they don't get the same compensation. You know, if things go brilliantly, private equity investors will get shot to the moon. It's unlimited, essentially. But bond investors, if things go brilliantly, bond investors will just get their original loan repaid plus a coupon interest and nothing more. So it is private. And if I go onto my Bloomberg terminal and look at, say, the covenants sitting behind a $4 billion loan to OpenAI, which is a private company, it tells me unknown. If I look at the financial ratios tab, so debt service coverage, asset coverage ratio, leverage ratio, I get unknown, unknown, unknown. I don't know. So that is where the risk is, Ed. It is the known unknowns, if you like.
Tracey, is there other risk, though, around whether the revenue that is being promised by some of these companies in some of these loans is being pulled forward?
Yes, if vendor financing, simply helps customers spread payments, then that's fine. But if it inflates near-term revenue by booking sales up front, that's when it starts to become a bit sketchy. And that's when you're funding your own growth. So lending money to customers to buy your own product. I think it becomes fraudulent when you do this knowingly. And so we just have to think back to Enron. That's what they did back in 2001 with related party transactions. And that's what led to the collapse of Arthur Andersen, the accounting firm, in 2002, because they signed off on it. Funny enough, I mean, it's the same kind of related party sketchiness that has been raised closer to home recently by ASIC, who flagged it as a concern in parts of the Australian private credit market.
So the concern would be the quality of the revenue, not necessarily the existence of financing itself.
I think that's a fair point. It's cash flow that matters. To be fair, there is no conclusive evidence that OpenAI is engaging in revenue pull forward. Just the issue is just simply opacity. Investors simply can't tell how much of the growth reflects genuine demand versus finance-driven deals.
Tracey, let's pivot from synthetic intelligence to something very real. That's gold. It's trading north of $4,000 an ounce, which is extraordinary. You've said recently that gold has stopped being a hedge and started being a referendum. What do you mean by that?
Well, yes, gold today isn't really about inflation anymore. It used to be. Historically, investors bought gold as an inflation hedge. So when inflation rose, you sought protection in hard assets. But this time, inflation is easing and gold's still rising. So that tells you it's not about inflation anymore. I think it's about politics. It's today more about trust. Gold at $4,000 is a statement. It's the market saying, we don't fully trust the political management of money anymore.
So you'd say this is more a vote of no confidence.
I would say it's a hedge against distrust. Yeah. When money becomes too political to believe in, investors turn to what can't be printed. The irony, I think, here is that as gold, Bitcoin, and other assets tied to distrust surge, the debasement trade itself has become the new bubble. You look at a chart of the gold price and it looks like a hockey stick. We used to buy these assets because we feared bubbles, you know. Now the fear itself has become the bubble. So how interesting is that? We've moved into a world where economic power is increasingly weaponized. Sanctions, trade restrictions, tariff regimes, they all blur the line between economics and politics. That makes the global monetary system feel less objective, less stable, a little bit more insecure and less rules-based. So gold becomes the default vote in this environment. It's the one asset with no counterparty and no political ideology.
It's really interesting. We've built a system that depends on our faith in fiat, in this case, the US dollar, but we price our distrust in fiat in US dollars per ounce.
Yeah, that's the paradox, isn't it? The distrust trade is denominated in the very thing it distrusts. But stepping back, what's really going on is a shift from inflation hedging to institutional trust hedging. Investors are hedging not against price levels, but against governance failure, fiscal dominance, policy overreach, political interference in central banks, gold, Bitcoin, even hard assets like farmland or infrastructure. They're all expressions of one question. Who do you trust to preserve value?
Interesting. What's the implication for portfolios?
Well, the first thing is to recognize why these assets are rising. They're not just risk-off trades, they're system distrust trades. Owning some of that makes sense as diversification, but just note that if everyone's running to the same lifeboat, that lifeboat gets crowded pretty quickly. The bigger takeaway, the more important one, I think, for us, is that trust has become a macro variable in itself. It used to be something just assumed. We didn't take politics really into account. Now you have to apply a discount factor to it. In the same way that future company earnings are worth less when inflation is high, trust is worth less when political interference is high. And so this plays out in the form of higher risk premiums. Not so long ago, the Australian government was seen as a riskier bet than the US government. And so our 10-year bond yield had to be significantly higher than that of the US in order to attract investors to us. Well, today, those yields are pretty much the same. So this is a new era, certainly for developed economies. Political trust is being discounted at different rates in different countries. And this means that investors really need to be discerning about where they invest, or at least make sure they are being rewarded appropriately for this additional risk.
Tracey, let's move to a related theme, risk management. You mentioned that a client asked you recently, how do you think about risk when adding a new fund to the portfolio? It's such an important question, particularly in times like these.
Oh, indeed. I loved that question because it gets to the heart of what we do. Everyone obsesses about return management, but not enough, in my view, about risk management. Adding a new fund isn't just about potential upside, it's about understanding what new risks you're introducing into your portfolio, and also what risks are you hedging or offsetting. One of the biggest blind spots I see today is the illusion of diversification. People own a dozen funds and assume that they're diversified, but many are exposed to the same macro drivers, US growth or AI. So if you think about the market ebbing and flowing, you don't want every part of your portfolio to ebb and flow at the same time. Ideally, you will have a series of locks, and that ebb and flow occurs at different rates. That will give you a nice, smooth overall outcome.
Right. And so even when allocations look different on paper, they can still be tied to the same global currents. So how do you identify genuine diversification?
Well, a true diversification starts with knowing your dependencies. It's a bit like what we were just saying about AI interconnectedness. You need to look at your portfolio closely. An easy way of looking at it is to observe what happens to the different parts of your portfolio when interest rates rise. So if you look at what happened to it in 2022, when we had an aggressive rate hiking cycle, if most of your portfolio was negatively impacted, then that suggests you likely had a growth bias in your portfolio. Now, if you want to balance that, you could add some value style funds, which didn't perform as badly in that environment.
So getting the balance right. That's a lesson for life, isn't it? Well, thanks, Tracey. That's all we have time for today. I hope everyone enjoyed the update. We look forward to you joining us for the next podcast. Until then, please take care and stay safe. Thank you.
Thank you for listening to Escala Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.